Hi, I'm Debra Brede, President of Brede Investment Management Company, and I'm here to talk to you about retirement income planning and strategies to give you tax-free income. 2010 brought a lot of uncertainty within the financial realm with estate planning and sunset provisions in question. One thing that is certain pertains to the Roth IRA. Many are still confused and not completely certain of what the conversion really means to them. Here's a look at 7 things that you need to know about Roth IRA conversions. Over the past 25 years, there have been 8 pieces of major legislation that directly impacted income taxes. Some increased taxes while others lowered them. It is also important to note, not always is the highest marginal tax rate changed, but the amount of money taxed at various rates changes. Because we do not know what taxes will look like throughout the future, it is important for you to limit your tax risk. Just like we reduce our risk in investing by holding a diversified portfolio, we can also reduce our tax risk by considering the same. Having a diversified portfolio from a tax perspective better positions you to manage tax law changes. Let's begin with a review of what a Roth IRA is. Unlike traditional IRAs, Roth IRAs do not have age restrictions on making contributions. They do, however, have income restrictions. As long as an individual has earned income within the stated limits, they can contribute to a Roth IRA. Similar to the 401k, Roths and traditional IRAs are aggregated for contribution limits. Your modified adjusted gross income for Roth IRA purposes is your adjusted gross income as shown on your return, modified as follows. You subtract the following. A conversion income. This is income resulting from the conversion of an IRA to a Roth IRA. B, minimum required distributions from IRAs for conversion modified adjusted gross income only. And then you add the following deductions and exclusions. You add traditional IRA deduction, student loan interest deduction, tuition and fees deduction, domestic production activities deduction, foreign earned income exclusion, foreign housing exclusion or deduction, exclusion of qualified bond interest shown on Form 8815, and exclusion of employer-provided adoption benefits shown on Form 8839. Lastly, let's look at how distributions from a Roth IRA work. Unlike the Roth 401k, distributions follow a specific ordering rule. Individuals are responsible for tracking this information. Since you can hold Roth accounts with more than one custodian, the custodian is not capable of properly documenting the dollars being distributed. You must aggregate all of your Roth IRAs when looking at the order of distributions and determining what type of money is being distributed. When taking a distribution from a Roth, your contributed dollars will always be removed first. Since they are after-tax dollars, they will never be subject to federal income or penalty taxes. This makes the Roth IRA extremely appealing if you may be concerned that you may have to tap into your account prior to retirement. Once all the contributions have been distributed, converted dollars will be removed next. There are 2 types of converted dollars, those that were taxed upon conversion and those that were not. These are after-tax dollars that were converted. The dollars that were taxed upon conversion will be removed second. These amounts will always be free from federal income tax, but may be subject to the 10% penalty tax if you did not hold the converted dollars in the Roth for 5 years or satisfy another exemption to the penalty under IRC Code Section 72T. The 5-year holding period applies to each conversion. So if you converted part of your IRA in 2010 and another part in 2011, each conversion would maintain its own holding period. This holding period only applies for the 10% penalty tax. The dollars that were not taxed upon conversion will be distributed third. These dollars are both federal income and penalty tax-free. Lastly, earnings will be distributed. Ideally, earnings will be removed federally income tax-free, but they must satisfy certain conditions for that to be the case. Earnings from a qualified distribution will be income and penalty tax-free for you. To be considered a qualified distribution, the Roth must have been maintained for at least 5 years, like the Roth 401k, and one of the following must apply. You are age 59 and a half, disabled, deceased, or a first-time home purchaser. Lifetime maximum of $10,000 of earnings. The 5-year clock begins effective January 1st of the year the first money was either contributed for or converted in. For instance, if you have never maintained a Roth and make a contribution on April 15, 2009, but attribute it to the 2008, the 5-year clock begins January 1, 2008. Unlike converted dollars, all earnings will be tracked to the same start date for determining the 5-year holding period. While money cannot be converted into a Roth 401k, you can convert distributions from IRAs and employer plans into Roth IRAs. Effective beginning in 2010, modified adjusted gross income restrictions are eliminated. Modified adjusted gross income is comprised of the income discussed earlier. Your adjusted gross income as shown on your return modified as follows. Subtract the following. Conversion income. This is any income resulting from the conversion of an IRA to a Roth IRA. Minimum required distributions from IRAs. For conversion, modified adjusted gross income only. Add the following deductions and exclusions. Traditional IRA deduction, student loan interest deduction, tuition and fees deduction, domestic production activities deduction, foreign earned income exclusion, foreign housing exclusion or deduction, exclusion of qualified bond interests shown on Form 8815, and exclusion of employer-provided adoption benefits shown on Form 8839. Individuals who complete any conversions during 2010 will qualify for special tax treatment. In all years after 2011, taxes are owed for the year the conversion occurs. When determining the taxability of a Roth conversion of an IRA that contains after-tax dollars, you must aggregate all the IRAs. The taxability of the conversion will be the same proportionate makeup as the aggregated IRAs. This is very similar to the non-qualified withdrawals from Roth 401ks that we discussed earlier. For instance, in the above scenario, you have 3 separate IRA accounts totaling $250,000. Out of the $250,000, $25,000 or 10% are after-tax dollars. Therefore, any conversion, regardless of which accounts are actually converted, will be made up of 10% after-tax dollars and 90% pre-tax. So if you converted the rollover account worth $200,000, you would have a taxable amount of $180,000. Under the old rules, you had to do a direct rollover from your 401k to a traditional IRA and then do a Roth conversion. If you had after-tax dollars in your plan, you rarely rolled them because you would lose accessibility as a result of the aggregation requirements. Since you can now go direct to a Roth, it not only streamlines the process, but it eliminates you from having to aggregate your after-tax money from the 401k with any pre-tax money in the IRA. You can now target just the after-tax bucket for conversion. When you convert your IRA to a Roth IRA, you will owe federal and state income tax on the amount of the conversion. For this strategy to make sense, you should be able to pay the taxes out of your taxable savings. This can be a smart move because it will, number 1, reduce the amount of your taxable estate, and number 2, create a lifetime of tax-free income for your heirs. Unlike traditional IRAs, you will never be required to take distributions of any amount from a Roth IRA in your lifetime. Your heirs will be required to take minimum distributions based on their life expectancies. Roth conversions are an important part of retirement income planning. Please feel free to call me to discuss your specific financial situation and how some of these strategies may benefit you.